everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. So we were originally going to do this video on Monday the 15th like we normally do, but we waited till today because we had the Federal Reserve interest rate decision. The Fed decided to cut interest rates by a quarter of a point, so 25 basis point cut. To nobody's surprise, I mean, the market had telegraphed that. Everybody was sort of calling for that, and so that's exactly what the Federal Reserve did. What people were much more interested in was the press conference and the comments from Jerome Powell about what they talked about in the meeting and where the Fed sees interest rates going and the U.S. economy going. And to me, it was a bit surprising that I thought the Fed would be more dovish or more in the camp where they're going to continue to aggressively cut interest rates, and that didn't seem to be the case. They were a little bit more hawkish than I thought that it would be, and so that was interesting to me. They don't seem quite as concerned about the employment situation as I thought they would be, and so that's interesting. I mean, it was interesting and I think surprising for some people. The interesting thing about markets is they had priced all of this in, and essentially stock markets and bond markets didn't go anywhere. So I know a lot of people out there that have high interest rate mortgages were thinking, well, I'll just wait till the Fed cuts in September and mortgage rates will go down. Well, the 10-year did not budge. It didn't go anywhere today because, remember, all markets are forward-looking. They're looking out to the future, and the market, both the bond market and the stock market, had priced this in. The other thing that continues to happen is the U.S. dollar has had an abysmal year. The dollar's gotten obliterated against major currencies around the world this year, and so that has had certainly a pretty major impact on asset allocation, and Josh can talk about that in a second. But I think the reality is the Fed is going to continue to be data dependent in the meetings to come, which is exactly what they should be, right? They have two mandates. One is full employment, and the other is keeping inflation in check. Well, inflation is a lot higher than they want it to be, according to their mandate, and employment is the employment picture is sort of weakening, and so they're in a very difficult place to be, and so they're going to continue to be data dependent in the meetings to come. That is until Jerome Powell ends his term and the president gets to install the person that he wants. And so that's going to be the real question. Does the president put somebody in there that cares less about the data and more about what the president wants? That's, I guess, to be determined. But I think that Jerome Powell has done a fabulous job sort of navigating the political pressure and the reality of what's happening in the economy. Because, you know, the reality is the economy is growing 3.5%, and it's doing okay. So the Fed had cutting, you know, based on the data, historically, they wouldn't have been cutting. But with the labor market weakening, I think that ultimately led them to cut. But it's not a done deal that they'll be cutting at the next meetings, and I think that was the surprise. And so Josh can talk about sort of that weakening dollar, the effects on our asset allocation, and for a lot of you, what's going to happen with short-term interest rates.
Yeah, just make one final summation of Tyler's point. If you were presented with data where the inflation outlook was increasing, you wouldn't actually anticipate the extent of dovishness that we really saw. And so I think there's a lot of uncertainty even on the Fed. There's obviously just one dissenter, which is the newly installed member, Stephen Moran, from yesterday. But no one really knows how this ends. And of course, Jay Powell leaves in May of 2026. And then we're going to have a completely new set of circumstances which to deal with. Overall, we feel super positive about our asset allocation. We're here in the middle of earnings season. Or after earnings season, stocks are of course really expensive on a valuation metric, but that kind of leads us to our next point, which is the dilemma that a lot of our clients are going to be facing in the months and years to come, which is what to do with all of that excess cash that no longer pays you a suitable yield. Inflation has been above the Fed's target now for close to 5 years. The inflation rate overall is 2.9%. Banks today are going to be racing to cut deposit rates. And so we foresee this dilemma for a lot of our clients. What are you going to do with the cash? The answer for a lot of people is some version of a bond ladder. But overall, there's just a massive flood of money in the economy looking for any place with yield. And so you're not really seeing sort of the risk-adjusted returns that we wish existed out there. But the other message that we want to send out to clients is really prepare yourselves for volatility, because when stocks are this expensive purely from a valuation standpoint, they're what we would call and characterize as priced for perfection, which just leaves them susceptible to exogenous shocks, and no one really knows ultimately what that exogenous shock or that risk that you can't plan for is going to be, but it certainly leaves room for pretty big sell-offs. And April for a lot of people was really traumatic, and if you're not capable of withstanding an April type environment, give us a ring and we can adjust your asset allocation accordingly.
Yeah, I mean, the other thing to know, with the dollar selling off as much as it had, that has led to dramatic outperformance of international. International, our exposure there is up 26% on a year-to-date basis. So international continues to pull its weight in your portfolio so far this year. And what Josh is talking about, a lot of you are going to have CDs and other things maturing in the coming months, and you're going to be real surprised at the renewal rate for a lot of those CDs. And so maybe taking a little bit of risk in the bond market might make some sense for that. And then just to reiterate what he said, you should all expect some volatility. Doesn't mean because we expect it it's going to happen, but you should expect it. It shouldn't surprise you. Remember, investing is not a binary decision, but we want you to mentally sort of prepare for that volatility, because the calmness that exists in markets starts to make me nervous, and there's a lot of calmness and bullishness right now, and that's usually precisely when we do get a sell-off.
We definitely sense a very ingrained sense of complacency out there amongst clients. Everyone, it's very difficult to find anyone that has a bearish outlook on stocks.
All right, as always, if you have questions about your account or your situation, give us a call at the office, 800-743-0988, or email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in a couple weeks.